Luke, let's talk a little bit about artificial intelligence here. Last couple weeks, it seems like the idea of valuations on AI companies has at least entered the chat. And this is something that just hasn't really been present for the last couple of years. It's just been, hey, every time you increase CapEx, your stock has gone up. And so, like, why wouldn't you keep pushing that button? Like, I understand all of the financial incentives driving this. But the last couple of weeks, it seems like there's been a different tenor to the conversations, and I'm wondering if you can give a little bit of color to that and some ideas to whether or not this does matter, will matter, or will continue to not matter.
Yeah, it's very interesting to me. I think it mainly came about somewhat last week. I would say early last week when there was a investment conference in Hong Kong and a couple of big Wall Street head honchos, including at Goldman Sachs, basically give a generic loud warning about high valuations, the risk of a market kind of pull back in the 10 to 15% range at some vague, indiscriminate point in the future. As sort of a catalyst for that, along that you also have Michael Burry raising some alarms about the space, which does tend to generate a lot of news flow. But when I think of the AI boom and assessing whether it's a bubble or not, I have to go to, okay, let's look at S&P 500 major company valuations. Right now, companies with a higher forward price to earnings ratio than NVIDIA include Costco, Walmart, and Starbucks. I think inasmuch as there is a valuation, or inasmuch as there are bubble concerns within AI, it should lay much more on the idea of an earnings bubble. The idea that, hey, the very outsized returns that are going to be generated in a boom obviously aren't going to last forever, this degree of growth. And what does growth look like on the other side of that? That, to me, is where the biggest idea of an AI bubble looks. It doesn't look as much in the valuations. In other words, I'm saying if we're going to be worried about an AI bubble even more, it's probably going to have to come with a lot more work on the valuation side, and those alarm bells getting a lot louder and a lot more blaring. Bank of America, for instance, yesterday basically said they had their global option strategists come out and say that, single stock volatility is rising, but not really as high as the dot-com bubble, and we think we're going there, therefore valuations and volatility should be rising. So that's actually a part of the leg that I would presume, as long as the earnings side cooperates, gets worse rather than gets better in terms of the kind of cries and concerns it's eliciting.
So is that kind of my view where I've kind of evolved to is like most technology, I believe that we're going to use way more AI over the next 5 to 10 years than we're using today. But it's also, like most technology, going to become commoditized because that's kind of what generally happens with most technologies. See the personal computer, smartphones aside from Apple, like the margins shrink into, oblivion, and you say, okay, we have to have a bunch of M&A in order to, save whatever's out there. But is this, kind of where we end up going, which is, yeah, we can use a lot more AI in the future, but in doing so, does it become commoditized and the margins get hit on that?
Oh man, you're speaking my language completely here. Yeah, the time where you have the most pricing power and in theory have the best margins is during the boom. It's now. So when you look at for instance the CoreWeaves and the Nebiuses of the world, which are saying, hey, like we're even right now able to lease old versions of chips, like the H100s, for instance, NVIDIA's chips, at rates that aren't too far off what we booked the initial contracts at. You say, hey, that sounds great, right? This sounds like longer useful life, some decent pricing power. And then you kind of have to remember that this is probably as good as it ever gets in terms of the demand outstripping supply, providing for that pricing power. So yeah, I am totally on board with that idea, and that kind of loops in what Jensen Huang talked about recently, and I think was really a point of emphasis for him at GTC speaking in DC. He was talking a lot about the efficiency improvements that are going to be a part of every generation of NVIDIA chips going forward. And so effectively what he's saying is like, hey, this isn't just about giving better AI compute. we're also trying to drive costs lower and try and provide that ongoing protection over time. Whether or not that's enough to offset kind of the more generalized loss of pricing power that you would expect to see as supply continue to get built out, and we get a better handle in terms of right sizing that to demand. I think that's, a very open question. But in terms of your view, is basically saying, is CoreWeave more like a high growing software firm, or is it more like, say, a classic US utility company? Probably over time it starts to look and act a lot more like the latter than like the former, and it's definitely more lumped in, I would say, with the former in terms of how it's priced.
So when we talk about kind of bucketing winners and losers, the question that I have outstanding, and I haven't looked at this, so I'm gonna ask you to look at this, Luke, and maybe you have already. Right now, you've got the providers of picks and shovels that are being projected as winners. The suppliers of the actual AI are being projected as winners, and the users of AI are being projected as winners. Basically, if you make the chips, if you make the models, or if you use the models, your stock has generally gone up shortly after announcements relating to those things. When this shakeout eventually occurs, which could be whenever, I have no clue, who typically ends up coming out in the best shape from those three groups? Because right now they're all projected to win.
I would say if we look at it from a kind of holistic historical perspective, I would say the end users or the most downstream that can apply the technology consistently after the boom are generally the ones that you would expect to be kind of having more benefits accrue to them over time, whereas just the one-off boost or the kind of more temporarily limited boost comes from the picks and shovels space. I would say, though, that speaking kind of more recently to recent price action, there has been, I would say, a degree of more nuance in the space. I think the best example is Meta. Meta is the kind of biggest of the publicly traded hyperscalers, the biggest one that doesn't really have a cloud business. So it's gotten to the point of Meta is in a place where it's much more downstream, I would say, in the AI game than others. And because of that, I would say it's kind of prove it on the spend. The expiry on that option is a lot closer than it is for, a Google or an Amazon, so to speak. It's because they have to effectively show that, we have ways of making money off this quickly and directly, whereas, Amazon, the Googles, they can say, well, we just need somebody else to look at this and say we might be able to make money off of this. So I would say that's been one kind of interesting part of nuance in the AI space lately, is that I'd point to kind of Meta as a kind of chief cause of worries downstream. And hey, if you're worried about downstream, eventually you probably get worried about upstream. Not saying that time is now, especially with Nvidia and Jensen pointing to 500 billion in sales in the pipeline for flagship chips.
Luke, we got to run.
But a good one to watch.
We got to run, Luke. Appreciate the time. We'll catch up with you soon. Luke Kawa from Sherwood News.